Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets buried in big company reports before they can even try to bury them. Today we are diving deep into AMG Funds III's latest filing, and let me tell you, it's got some interesting layers, especially when it comes to how they are managing your money. This report gives us a peek under the hood of AMG GW&K International Small Cap Fund, showing us exactly how your investments have been managed over the past 6 months. We will break down the key financial figures, understand the risks they're talking about, and figure out what it all means for the people who entrusted them with their hard-earned cash. Stick around. Because understanding this stuff is crucial for your financial future. And hey, if you're getting value out of these deep dives, make sure you subscribe. We also have a fantastic community over on our Discord linked in the description below. Alright, let's get straight to it. This is a semi-annual shareholder report, meaning it covers the period from the 1st of June 2025 to the 30th of November 2025. Think of it as a midterm progress report for the fund. First off, let's talk about what it costs you to be invested in this fund. For every $10,000 you invest in the Class N shares, you are looking at about $59 in costs over these 6 months. That might sound small, but it translates to 1.14% of your investment. For Class A shares, it is a bit cheaper at $51 or 0.99%. And for Class Z shares, the most economical, it's just $46, which is 0.89%. These differences might seem minor, but over long periods, they can really eat into your returns. It's like choosing between a slightly faster lane with a toll or a free, but slower. Now, let's look at the fund's overall size and health. As of the 30th of November 2025, the fund managed a total of assets totaling over $43.5 million. That is a pretty significant chunk of change. They hold 76 different investments in their portfolio. One figure that caught my eye is the portfolio turnover rate, which stands at 15%. This tells us how often the fund manager is buying and selling investments within the portfolio. A 15% turnover rate is relatively low, suggesting a more buy and hold strategy, which can be good for reducing trading costs and potentially for long-term growth by letting investments mature. It is not constantly churning through stocks. Here is where it gets really interesting. Looking at their top holdings, they have about 2.4% of their assets in the Tel Aviv Stock Exchange, limited in Israel, then Gift Holdings Inc. from Japan accounts for 2.3%. Phoenix Financial Limited in Israel is next at 2.2%, followed by Sensu Electric Company Limited, also from Japan, at 2.2%. Alopic Assa in Norway is at 2.0% and Digital Information Technologies Corp. in Japan takes up another 2.0%, Kitron Assa in Norway, Garrett Motion Inc. in Switzerland, Nitera Company. Limited in Japan and Sarantis A in Greece round out the top 10, each holding around 1.9%. Altogether, these top 10 holdings make up a substantial 20.7% of the fund's total assets. This concentration means the performance of these few companies can significantly impact the overall fund's performance. Let's dig into the detailed breakdown of their investments. They have a significant portion, 94.4%, in common stocks. Within that, industrials make up a hefty 27.0%. That means almost a quarter of their investments are in companies related to manufacturing, construction, or other heavy industries. Next up is information technology at 16.5%. Followed by consumer discretionary at 15.5%. Consumer staples, which are everyday necessities, hold 6.8%. Financials are at 12.0%, materials at 6.4%, healthcare at 5.5%, communication services at 3.1%, and finally, real estate at 1.6%. Within the communication services sector, they hold N-Ion Falcom Corp. from Japan, Paradox Interactive AB from Sweden, and Rightmove PLC from the United Kingdom. For consumer discretionary, we see companies like Cairn Homes PLC in Ireland, Games Workshop Group PLC in the United Kingdom, and Garrett Motion Inc. in Switzerland. This diverse mix of industries shows they are not putting all their eggs in one basket, at least not across all sectors. In consumer staples, they have Beckler Sabda CV in Mexico, Grupo Herdez Sabda CV in Mexico, and Sarantis, Saran Greece. This sector is generally seen as more stable because people always need these products, even when the economy is shaky. For financials, names like BFF Bank SPA in Italy, Bolsa Mexicana de Valores Sabda CV in Mexico, and Phoenix Financial Limited in Israel pop up. This sector is critical for the economy handling money and investments. In the healthcare sector, we see GVSPA in Italy and Hallpark Corp. Limited in Singapore. This sector is often seen as defensive, meaning it tends to perform relatively well even during economic downturns because healthcare is a basic need. The large industrials allocation includes companies like Adentra Inc. in Canada, Ashtead Technology Holdings plc in the United Kingdom, and Clarkson plc in the United Kingdom. This sector's performance is often tied to the overall health of the economy, as industrial output and demand can rise and fall with economic cycles. For information technology, they are invested in AI Holdings Corp. In Japan, Argo Graphics Inc. in Japan, and Digital Information Technologies Corp. In Japan, among others, this sector is driven by innovation and can offer high growth potential, but also comes with its own set of risks related to rapid technological changes and competition. In materials, we find Cortesera Amorum SGPs, SA in Portugal, Alopak ASA in Norway, and Northcorp. In Japan, this sector is crucial for producing raw materials used in various industries. And finally, in real estate, they have SafeStore Holdings plc in the United Kingdom. Interestingly, they also hold 6.8% in short-term investments. This includes joint repurchase agreements and repurchase agreements. These are essentially short-term lending arrangements where the fund provides money in exchange for collateral, often government bonds. This portion of the portfolio is generally considered to be lower risk and is used to manage liquidity. Looking at the statement of assets and liabilities, the fund's total assets are around $44.3 million. On the liabilities side, they have about $791,000. This leaves them with net assets of approximately $43.5 million. This is the actual value of the fund that belongs to the shareholders. Let us break this down by share class. Class N shares have net assets of about $2.55 million. Shares outstanding for this class are around 50,894, with a net asset value per S-share of $50.13. Class I shares are the largest by far, with net assets of nearly $38.3 million. They have 693,325 shares outstanding, and the net asset value per S-share is $55.19. This class also has a lower expense ratio, which is a good thing for investors. Then we have Class Z shares with net assets of about $2.68 million. They have 48,455 shares outstanding, and the net asset value per S-share is $55.41. Now for the statement of operations, which shows how the fund made and spent money over the 6 months. They generated $444,546 in dividend income and $20,287 from interest income. They also earned $17,452 from securities lending income, after accounting for foreign withholding taxes. Their total investment income came in at $436,678. On the expense side, the fund incurred various costs like investment advisory and management fees, administrative fees, custodian fees, and more. The total expenses before any offsets were $284,505. After expense reimbursements, the net expenses were $204,817. This resulted in a net investment income of $231,861. But the real story is in the games. They had a net realized gain on investments of $840,705, and the change in unrealized appreciation on investments was even larger, at $1,436,676. So their total net realized and unrealized gain for the period was $2,263,555. Combined with the investment income, the net increase in net assets resulting from operations was a healthy $2,495,416. This shows the fund has been performing well in terms of growing its value. Looking at the statements of changes in net assets, we see that for the 6 months ending the 30th of November 2025, the fund saw a total increase in net assets of almost $4.7 million. This is a significant increase compared to the fiscal year ended May 31, 2025, where they actually saw a decrease of over $1.3 million. This upturn is a positive sign. The financial highlights provide a per-share view of performance. For Class N shares, the net asset value per S-share grew from $47.16 at the start of the period to $50.13 at the end. The total return for this period was 6.30%. For Class I shares, the net asset value per share went from $51.88 to $55.19, with a total return of 6.38%. Class Z shares saw their net asset value per S-share rise from $52.06 to $55.41, with a total return of 6.44%. These figures confirm the positive performance across all classes. Now, let's carefully look at the notes to financial statements. These provide crucial details and context. Under valuation of investments, they explain how they determine the worth of their holdings. Generally, they rely on market prices, but for securities where market quotes aren't readily available, they use fair value estimations. They highlight that fair value determinations are subject to oversight by the Board of Trustees, and they use a 3 level hierarchy to classify these valuations based on the observability of the inputs. Level 1 uses quoted prices in active markets, Level 2 uses observable inputs, and Level 3 uses unobservable inputs. This is important because it shows their commitment to transparency in valuing less liquid assets. The section on agreements and transactions with affiliates is particularly insightful. It details the relationship between AMG Funds LLC, the investment manager, and GW&K Investment Management LLC, the sub-advisor. It's important to note that AMG indirectly owns a majority interest in GW&K. This means to raise an internal synergy, but also potential for conflicts of interest that the board is supposed to monitor. They mention the investment manager contractually agreed to limit total annual operating expenses through the 1st of October 2026, which is great for investors as it caps costs. They also reimburse the fund for expenses and may recover these amounts later, but only if it does not exceed the agreed upon expense cap. This contractual expense limitation is a significant detail, capping net annual operating expenses at 0.89% of average daily net assets for a period. This is a key investor protection. The fund also participates in a securities lending program. This means they lend out some of their securities to borrowers earning income on those loans. They receive collateral for these loans, typically cash or US Treasury obligations. The value of loan securities was around $2.2 million. With over $2.29 million in collateral received. This can add a small boost to returns, but it does come with risks, although they state they are indemnified by Bemni Mellon for potential losses. Finally, the statement regarding basis for approval of investment advisory contract explains how the Board of Trustees approved the agreements with their investment manager and sub-advisor. They reviewed performance compared to peers and benchmarks, fees, and profitability. They noted that the fund's performance for Class I shares was below the median for peer groups and below the benchmark for certain periods. But they also acknowledged the strong long-term track record of the sub-advisor's investment strategy and the fact that the fund outperformed its benchmark in 2022. The board also considered the expense limitation agreement and concluded that the fees were reasonable. Now, let's look at the bigger picture. AMG Funds III, through its GW&K International Small Cap Fund, seems to be navigating the market reasonably well, especially in the second half of 2025. The fund's performance has seen a strong rebound, evident in the increased net assets and positive total returns across all share classes. The 15% portfolio turnover suggests a disciplined, long-term approach by the fund managers. The expense limitations and the detailed disclosures around fair value investments indicate a commitment to transparency and cost control for investors. However, there are a few points to consider. While the Class I shares are the largest, their historical performance, as noted by the board, has at times lagged behind peers and benchmarks. Though the sub-advisor's strategy has a strong long-term record, the concentration within the top 10 holdings, particularly in specific countries like Israel and Japan, and across sectors like industrials, means that the fund's performance is quite sensitive to the fortunes of these few companies and regions. Emerging markets risk, foreign investment risk, and currency risk are all explicitly mentioned, reminding investors of the inherent volatility in international small-cap investing. In conclusion, this report paints a picture of a fund that, while having periods of underperformance relative to some benchmarks, demonstrates sound management practices, friendly expense controls, and a clear strategy. The recent upturn in performance is encouraging. Investors should, however, be aware of the concentrated nature of the portfolio and the associated risks of international small-cap investing. It seems like a solid choice for those comfortable with those specific risks, but it's definitely not a set and forget it kind of investment. Alright, that is our deep dive into the AMG Funds III filing. What do you think about their investment strategy and recent performance? Do the concentrations in certain countries or sectors concern you? Let us know your thoughts down in the comments below. If you found this analysis helpful, please give it a thumbs up. Subscribe for more corporate breakdowns, and don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we will see you in the next one.